OG John AG here. You've seen the thumbnails: Comex default, system collapse, silver to $200, $300, $500. But a new deep dive from Discovery Alert goes in a different direction. It says, yes, the math is scary. Yes, March 2026 is critical. But no, a Hollywood-style Comex bankruptcy is still not the most likely outcome. Tonight we're going to walk through what default actually means in the Comex silver market, why March 2026 is the month everyone's watching the brutal math, open interest versus inventories, and what happens if too many people ask for bars. The bull case that sees silver blasting past $200 in a squeeze. And the base case, how the exchange can change the rules and survive, even if you don't get the metal you thought you were owed. I don't sell courses. I don't sell signals. I don't run a VIP Telegram. And I will never DM you asking for money. I am only on YouTube, this channel John AG here, and the name is OG John AG. If it's not here, it's not me. Let's start with the fear word, default. Segment 1. What does a Comex default actually mean? When people say Comex default, most imagine lights go out, exchange bankrupt. Everyone loses everything, silver rockets to the moon overnight. That makes for great thumbnails. But that's not how the article, or serious analysts, define it. Discovery Alert explains, Comex is a futures market, not a metal supermarket. Most contracts never result in physical delivery. They're opened and closed for price exposure, hedging, or speculation. A default-style event, in professional language, usually means the exchange cannot or will not meet physical delivery demands under the original expected terms. Instead of bars, it forces cash settlement, delays, or changes the rules to protect the system. Legally, that might not be called a default. Functionally, for someone who wanted metal, not paper, it feels like one. So in this video, when we say default risk, we're talking about a point where Comex cannot satisfy physical delivery at the posted paper price in a normal way and has to resort to emergency measures. That's what March 2026 is all about. Segment 2, why March 2026 is in the crosshairs. The article points to March 2026 as a key inflection point. Here's why. March is a major delivery month for silver futures. Significant open interest can remain into the delivery period. If a higher than usual share of those contract holders decide, I don't want cash, I don't want a roll, I want bars, then the system gets tested. FX-style research and other analysts warn, if roughly 25% of open contracts demanded delivery, Comex could theoretically run out of deliverable silver. Recent delivery activity has already been unusual. 1 January saw around 40 million ounces demanded for delivery, a big chunk of registered inventories. So March sits at the crossroads of elevated investor interest after a violent crash and bounce, tight inventories relative to paper claims, and a calendar structure that concentrates delivery risk into a few key months. It's not a guarantee of disaster. It's a scheduled stress test for the system. Segment 3, the brutal math, paper versus metal. Let's talk numbers. Across multiple analyses, including FX Empire and similar work, the basic picture looks like this. Registered silver in Comex vaults, the metal explicitly available for delivery, has been hovering around 120 million ounces. Total open interest in silver futures often represents hundreds of millions of ounces, roughly 4x or more the registered inventory at times. The exact ratios change day to day, but the structure is clear. The system is essentially fractional reserve in metal. There are far more paper promises than there are deliverable bars. Under normal conditions, most positions are closed or rolled. Only a small fraction go to delivery. The fractional structure works, but if conditions stop being normal, like loss of confidence in the system, wholesale rush for physical large players deciding to stand for delivery in size, then the math starts to bite. Remember the key scenario many analysts highlight. If roughly 1/4 of contract holders demanded bars instead of cash, Comex would be under severe stress to supply enough metal and could exhaust registered inventories. That's where the default talk comes from, not conspiracy, just simple ratios. Segment 4, the bull case, 200 plus, silver and systemic risk. The article links this to what a lot of people are calling the bull case. Here's that story in plain language. Robert Kiyosaki has publicly talked about silver reaching $200 in 2026, tying it to a weakening fiat system, accumulating debt, and rising industrial demand, especially solar and AI infrastructure. Analysts like Thompson warn that, under current trends, Comex could run out of deliverable silver sometime around March 2026, or face recurring strain later in May or July. Commentators like Holter stretch it further, suggesting a silver delivery crisis could spill into gold, trigger wider loss of confidence in paper claims, and potentially stress the broader financial system. FX-style pieces go as far as writing headlines like, a Comex default could push prices above 200, Comex default looms, silver poised to explode past $200 Oz in epic squeeze. The logic: if Comex cannot honor physical deliveries the way participants expect, the market loses faith in paper silver. People rush to secure real metal, not contracts. A scramble for limited above-ground inventory drives prices into a new regime. $200, $250, sometimes even higher in extreme scenarios. This is the mega squeeze scenario. Default stress, paper credibility collapse, physical scramble, vertical price move. It's not guaranteed, but it's serious enough that multiple analysts, not just fringe YouTubers, are modeling it as a scenario with non-zero probability. Segment 5. The skeptical case: why a clean bankruptcy default is unlikely. Discovery alert, though, doesn't stop at the bull case. They emphasize the skeptical case, too. Exchanges are built with mechanisms to avoid outright collapse. Comex has tools: margin hikes, position limits, force majeure clauses, cash-only settlement in extreme situations. From this angle, a full legal "we failed, we're bankrupt" default is very unlikely. Before it gets there, the exchange can, and likely will, force people out of positions via margin. Change delivery rules. Offer or enforce cash settlement instead of metal. In other words, the system is designed to survive even if you don't get what you thought you signed up for. For a trader, that might feel like a default. But for the lawyers and regulators, it's orderly risk management. So the skeptical case is Comex will probably not go down in flames. It will change the game mid-match to protect itself, as it has done in past crises. You might not like it. You might not get metal. But the institution remains standing. Segment 6. What a 2026 default-style event could really look like. Put the bull and skeptical cases together, and you get something more nuanced. A 2026 default-style event might look like: first, pressure. Inventories fall. Registered stocks shrink. Delivery demands rise. Then, stress. Lease rates spike. Backwardation deepens. Physical premiums rise in key hubs. Then, a trigger. A major delivery month like March or May, a large miner, industrial user, or fund chooses to stand for delivery in size. Another shock hits confidence in fiat or banking. And finally, response. Comex raises margins again, tightens or caps position sizes, offers or enforces cash settlement instead of bars. Prices in that environment could spike violently higher as physical buyers panic, investors see the writing on the wall, or chop sideways at crazy volatility while rules are improvised in real time. The article's point: a formal catastrophic default is still low probability. A messy, legally sanctioned failure to deliver in the way people expect, with big price dislocations, is much more realistic. That's the scenario serious minds are gaming out. Segment 7. How this ties into the 1979-1980 analogy. The piece and related research keep referencing 1979-1980, the Hunt brothers' silver crisis. Back then, silver prices exploded higher as the Hunts accumulated physical and futures. The exchange responded by raising margins, changing rules, restricting new long positions. Prices went vertical, then collapsed, leaving behind a scarred market, but an exchange that survived. The 2026 analogy is: silver has already shown 1980-style volatility, big spikes, big crashes, margin hikes. The structural backdrop is tighter today, more industrial demand, solar, EVs, tech, multiple years of deficit-concentrated reserves and geopolitical competition. The question isn't, will 1980 repeat exactly? It's, will we see a modern version where paper and physical diverge, rules change mid-game, and silver ends the decade in a totally different price regime? A March 2026 delivery crunch could be one of the triggers. It doesn't have to be the only one. Segment 8. What this means for you. Trader versus stacker mindset. Now let's talk about you. If you're a trader, you cannot treat silver like a slow, safe commodity. You're trading inside a system where margins can jump overnight, rules can change, volatility can explode with little warning. That means use conservative leverage, respect risk limits, assume rule changes are possible in extreme setups. If you're a stacker, long-term investor, this whole Comex default debate actually confirms a few things. Paper claims are not the same as metal in hand. The big stress dynamics are about who gets what when the music stops. The very fact that analysts are modeling 200+ default scenarios tells you how fragile the paper side has become. Your job isn't to guess if March is the month. Your job is to decide, do you trust the system enough to rely only on paper, or do you want at least some exposure to physical or less levered forms of silver? Segment 9, call to action for your viewers. You're watching John A.G. here, and I'm OG John A.G. If this breakdown helped you see the Comex 2026 default debate as more than just hype a real structural tension between math, metal, and rules, then hit subscribe right now so you don't miss the next deep dive on silver, gold, and the plumbing behind the charts. Smash like so this kind of long-form context beats the shallow fear thumbnails. Comment March 2026 if you're now watching that month as a real stress test, and tell me if you're thinking more like a trader or a stacker in this setup. We're going to keep tracking Comex inventories and open interest margin changes and delivery stats, analyst scenarios for $100, $200, and beyond, and how physical demand and deficits evolve as this story plays out. Because in a market like this, understanding the rules of the game is just as important as watching the price.